what you said earlier about high claims. But you additionally said that the prescription drug rebate of approximately 1.1 million we should see at the end of March. Is that included in this deficit that we're talking about, the prescription drug rebate?
We have some more rebates coming in that will help us out in this manner. But as of August, our increase on a per employee per month basis was 2.9%.
And I will say, Katie, that when we're finalizing the numbers for our fiscal year, we do bring in the rebates that relate to that fiscal year. So if we have a lag in receiving a $1 million rebate from prescription drugs, we would accrue for it and bring it into the fiscal year 20 health plan year. So from the typically our coverage runs for a calendar year, but our reporting for purposes of our CAFR, our audit report, is fiscal year. So those would have been pulled into the June 30 numbers. That 3.1 million unaudited deficit would reflect those rebates.
Okay. And my other question was, the last time we met, there was some indication that maybe our claims were beginning to level off. Are you still seeing that, or are they going up?
Lynn, you want to take that, or you want?
I'll take that. We've leveled off for a while. We did have a bit of a high week this week. We'd had a couple of additional new claimants, but they have leveled off to a much better level. So I'll tell you, usually we're looking at 550, 600,000 would be an average month, as we've seen maybe in 2019. Obviously, we had some lower months during the COVID period, the stay-at-home period, but our weekly claims went from that 550, 600 to $1 million plus for several weeks once the stay-at-home order was lifted. And we did have some weeks recently below 500,000. Monday came in a little over 600,000. So with continued some luck on that claims history, you know, we should normalize back to our average there.
Yeah, Katie, I would like to add that as we mentioned in a previous meeting, our claims for July and August were very high, and we thought some of that were due to the procedures that may have been put off because of what was happening with COVID.
Absolutely.
Yeah.
So sorry, who's talking right now, so I would know.
Kelly.
Oh, okay, thank you.
Okay. So basically, Katie, what we do is as the claims run from Blue Cross comes in once a week. So we're getting those weekly, and we are accumulating it weekly, and we compare year to date of this year to year to date of last year. If nothing else, just to see how we're doing up through, in this case, October. And so from a group health claim standpoint, we're about 65,000 less than last year in terms of our group health claims, about 65,000 less than. And with regards to prescription drugs, we're about 62,000, 52,000 higher than last year. So if you net the two, give or take $10,000, we're pretty much tracking in total, not by week, but in total, the claims for medical and prescription drugs. So we're looking, of course, for the impact for the plan benefit changes that we've made. but it's still too early to say anything conclusively, but we can say that we're pretty much tracking the claims through October currently as were incurred in fiscal year 20. Fiscal year 20, not the calendar year, fiscal year. So.
Okay, thank you.
Any more questions for Billy Guidry? Katie?
Billy, I'm sorry.
Matt?
Billy, on that unaudited number, and I don't want anybody to be surprised, and we did mark it unaudited, but, and this might have been explained in the last meeting. So this number is as of things that we had paid through June. What the auditors will do, will book additional claims that occurred in April, May, and June, but not have been paid until through September. Baked in that number is an estimate of that. But what worries me is that when Lynn says that we had a spike, that we would have a spike in that number, meaning our estimate might be underestimated.
Well, in the estimate that Matt's referring to is basically the number from the previous year, from 19. So if we've experienced a significant increase in the claims that relate to fiscal year 20, but weren't paid till after fiscal year 20, in other words, they were paid in July of 20, August of 20, September of 20, then that estimate is going to have to be increased. We use the prior year numbers because when we're preparing these numbers, we don't have those numbers available to us because we're preparing this in July and first couple of weeks of August, and the auditors are using information for all of August and all of September. So they're looking at a complete set of numbers. We're looking at the numbers we have through mid-August. So that's why we use the prior year as an estimate. We don't have the numbers to make that calculation. The auditors have it because they're in now, and so they're in October. They now have a full July, full August, full September numbers to be able to make that calculation. So that is why we couldn't estimate whether or not there's going to be a significant increase to the estimate we had come up with.
And the budget and the number that the board had when they did their budget, which was the number I was operating with, was 6.8 million. Is that correct? I think it was a 2019 fund balance. It was 6,817,523, I think.
What is your question with regards to that amount?
The question is, that's the beginning fund balance that was available to the board when they did the budget, approved the 2021 budget. Is that correct?
Yes, it is.
Okay. Thank you. And Trish, Deborah Thrower has joined, and CG did for a minute, but now I think, yes, CG's here. So Donna, if you can sometime get the minutes you've taken to CG, I would appreciate it. And CG, you can pick up from there.
Okay, I'll retire. Very good.
Any more questions for Mr. Guidry?
I appreciate it, Ms. Donna.
You're welcome.
The only other comment I would make is that the 8 million number he had was the last time we had an increase. I think, Mr. Guidry, our last increase was, or Lynn, was 2017. Is that correct?
That's correct.
Okay. All right, next up is in our education night is Mr. Dugas, who's going to talk about OPEB. Some people complain that we talk about it all the time and they don't know what it means. OPEB stands for Other Post-Employment Benefits, and it is a program that has public officials. First, they were required to indicate what their unfunded liability was, how much money they would have to pay if we all retired at the same time. It's a tremendous amount of money. It's required of school boards, cities, parish governments, state government, I guess, I don't know, but it's required by the people who govern accountants. Matt is going to present, and you have on the screen in front of you, what the amount is in OPEB, less the interest, I'm assuming, Matt, because I think the total is 17 million.
Yes.
But, okay, and you'll notice that the contributions, when this fund started, was about $7 million that came from the insurance fund. If you look at your column on the left, you'll see dollars that came from the insurance fund and dollars that came from the general fund. And I see that we added, I didn't have that last number, apparently $1 million was added in the current year budget to OPEB. And the committee had requested to reduce the amount sent to OPEB. And then in the right column, since our insurance is funded by both the premiums we pay and by the general fund, which the board manages in tax dollars, the columns on the right show you how much the employee column, I believe, is from premium money, and general fund dollars is on the left. But Matt, I'll turn it over to you.
Yeah, so basically, OPEB, she's right, other post-employment benefits, basically, it's kind of, it's the retirement for the insurance for retirees. So when we retire, when employees retire, they promise you health insurance post-retirement. That is a promise. It doesn't have any money behind it. So what the people that issue debt and look at financials say is, you know, you're making these promises to the retirees, but you're not putting any money behind it. You're doing a pay-as-you-go, similar to our retirement system. I know back in the 80s, the retirement system was a pay-as-you-go. They've increased that rate. We're now trying to catch up with the cost of that retirement being actually in the retirement fund and not as a pay-as-you-go. So back in 2005, we started discussing the establishment of a trust in which money would go into the trust to help provide money eventually to help offset this liability, because we knew that coming down the line, we'd have to disclose this huge liability on our financials, and that did occur. So back in 2010, the board established this trust and did send that money from the insurance fund, the $3 million and the $4 million. Today, I was able to dig back into some of the paperwork because the board had been accumulating money reserved for this purpose in the insurance fund over time. And when I looked at it, they had sent 1.3 million in 2005. They had sent $1 million in 2006, and then another 620,000 in 2011.
Excuse me, Matt, can you do that slower? Because we need to add it to this column. This has you starting in 2010. So you said you started as early as when?
When I did this schedule, I was digging into my paperwork this afternoon, actually about an hour ago, and I found this transfer sheet that I did way back when the board started accumulating, because we didn't have a trust, but they wanted to put money aside. So instead of keeping it in the general fund, they sent it to the insurance trust and reserved it in there, waiting for the trust to be established. So in 2005, they sent $1,306,550. It's an odd number. That's what it is. 2006, they sent $1,006,550. Then in 2007, they sent $6,550. And then in 2000, nothing in 9 or 10 or 8. And then in 2011, they sent $621,529, which puts it right at $3 million. So I think that initial $3 million was money that the general fund had been sending to the insurance fund to reserve it in preparation for this very issue. So that money, it took us a while to set up the trust. They had to have legislation that was passed. Once the legislation was passed, we had DeSoto Parish actually create the first trust. They spent all the money on the legalese. We came in after them and kind of took the lead in that. I think right now we're at 6 school districts that have OPEB trust. It came up in our bond issue. We just refunded some bonds. We now have the highest bond rating in the state. This was mentioned as one of the reasons we have such a high bond rating, because we are addressing it. We're not addressing it aggressively, but we are addressing it. We have a trust and we have money in it. So that means a lot when you talk to Wall Street, when you're issuing debt or when you're refunding debt. So we just saved $3 million in interest on 2 different bond issues we refunded a week ago with our AAA A++ bond rating, which is the highest in the state. And in that board meeting or the board workshop that we had on that, we discussed the OPEB trust and the effect it does have on our bond rating. And also it guarantees that money will be there at some point when retirees do retire, that they will have health insurance and money to back it up rather than just a promise.
Any questions for Mr. Dugas about OPEB trust?
Yeah, Matt,
Okay,
this is Butch.
Butch?
Okay, to date, what would we need in the trust fund? Now, this is to date, this year. What would we need in that trust fund in order to be able to be current?
Fully funded, it's a lot of money. It's close to $400 million, which is basically the cost of everybody who has retired that is still living and everybody that's still working that has more than 1 year of experience. So if I'm a teacher with 20 years of experience, I should have 20 years of contributions to this trust to cover my insurance when I retire. If I'm retired, I should have 30 years or whatever it is. So all that is included. What our goal is eventually, and this is kind of the story I'm using to help us with the bond rating agencies, is to get to the point where we put enough money in there to cover this year. So if a teacher starts right out of college this year and we're able to meet the requirement of everybody that worked this year, eventually corrects itself. This is a huge problem that has occurred over time. It's not going to be corrected quick or easily. But what they want to see is that we're not ignoring it, that we're in the group I call the B group, which is the group that is doing something about it. They have the A group who is fully funded, and there are a few of those districts. They have the B group like us that are addressing it, but not really enough. And then they have the C group who's ignoring it.
I have a question.
We want to get into the B group.
CG has a question?
Yes, ma'am. I remember at a previous meeting, Matt, you had discussed the fact that, I don't know if you said if it was not fully funded, if that would be a potential for retirees in the future to not actually have those benefits. What is the actual, I don't know how to even say, maybe the rate, or what happens if we do not fully fund? I mean, will we lose as, younger teachers? I only have 14 years. And so I'm worried that kind of like Social Security, is it going to just be gone by the time I need it?
Well, right now, it is legally required that we provide you with this health insurance to understand by the state. But that's only a majority rule and a governor's signature to take that away. If that were to be taken away today, we'd have $17 million to at least fund about 1 year of coverage for retirees. So it does give us some leeway. It's better than nothing. So the plan now is to do pay as you go, as we have in the past, and start and putting a little bit of money aside. So the $400,000 for the insurance fund, the board this year, as of 2021, has changed that into the funding structure as part of the premium paid by the general fund and, more importantly, by the grants. So another issue here is, so if I work for Title I the day I start, and I work for Title I for 30 years, the day I retire, I become a liability of the insurance fund because you now have to cover my insurance benefits for the rest of my life, but I didn't put any money into that trust. And Title I didn't put any money into that trust. Title I is okay with putting money into the trust as long as other people do. So by putting it into the funding structure and insurance, we cleared this with the federal people. They are okay with paying that amount to the trust. So now we have not only the general fund making contributions to this trust, we also have Title I, food service, all the other grants that we have employees working for are now paying for those employees that are in that fund. They're paying for their contribution to this trust, so that someday if we get this trust fully funded, it will be not only with general fund money, but with grant money and Title I money to cover those employees that work for those systems that may have never worked or never been on insurance if Title I didn't exist.
Is there a deadline or anything if we
No.
do not receive that funding?
Excuse me, I didn't hear you say that again.
She asked if there were a deadline.
No, there's no deadline per se, but when we speak to the rating agencies, we tell them, we have a plan, and they really they even mentioned the plan about putting it into the structure of the premium. And I'm working with St. Tammany Parish, the CFO of St. Tammany Parish. We talked yesterday and the day before. I've sent her all the information. I've sent her our matrix, and they will probably do the same thing when they start their trust. They have $60 million put aside for their trust right now in reserve, similar to what we did with the $7 million when we started. So as of the beginning of the year, we'll see how much they're going to contribute to the trust. But I was told by our investment advisor that they have about $60 million reserved for that purpose right now in St. Tammany Parish.
Any more questions for Mr. Dugan?
I do. This is Katie. Matt, I was going to ask. First of all, I'm glad you clarified because my memory did serve me correctly. I thought we started contributing before 2010. So I'm glad you did clarify that.
We did, but we didn't have a trust to send it to.
Yeah, but we were taking it out of insurance reserve at that time.
We were reserving it in the insurance fund, but general fund was sending extra money to the insurance fund at that time to do the initial $3 million. Yes.
All right, and starting in 2010, then 2010 $3 million from insurance. 2011 $4 million, and it goes on. And to the side, you have it separated. But when in reality, let's just say the first $7 million from 10 and 11, that was in insurance reserve, as we called it then, or fund balance. And it was earmarked. That total amount was earmarked for fund balance to be used in a rainy day, and on and on. So it's not like that money was in general fund. Granted, part of that was premium, and I understand why you're putting it, but in reality, that was like $7 million that was in our general fund and moved to OPEB. So when you look at it that way, over the years, and with the $3 million you included, without the $3 million, that's over $9 million that was in our fund balance insurance for a rainy day.
No, the $3 million is not in addition to, it is the original $3 million.
Oh, well, then it's not without the $3 million, Matt. It would have been $12 million. So it's
Yes.
$9 million to add up the fund balance. Okay. So,
No.
well, then I
No,
don't
the
know.
$3 million was sent from the general fund to the
I
insurance
understand
fund.
that, but I'm not including 2005, that $3 million down. I'm starting in 2010 to present. It's been $9 million in our fund balance. And it's been earmarked for rainy day. And I know that, it's been moved to OPEB, but that money was in reserve for rainy day, and we're getting ready to have a monsoon, it looks like. And now
It was
we're
in reserve for OPEB, not for rainy day.
no, Matt, that is not correct. And
No, we don't have OPEB.
No, that was not OPEC. That was in fund balance, okay? And that was reserved for if we needed it. Now, you came up with the idea of the trust fund and you started putting in there, and I understand that, over the objections of the committee many years.
Yes.
The point I'm trying to make is that we would have 9 million more, and now we're down to 3 million. So we would have had 12 million presently had we not contributed. And I understand the reason for contributing. I really do. I guess what's perplexing is only 6 school systems in the state contribute, okay, and have been contributing. St. Tammany, I was told, is putting 20 million in, but that's from their general fund, and maybe 1 million from their insurance reserve. When you look at Jefferson, it came from Deepwater Horizon settlement funds. When you look at St. Charles, it comes from their general fund, ad valorem, and sales tax. So not every district actually just a few districts are using their insurance fund balance to contribute to OPEB. And I just wanted to make that clear. I understand why we're doing it. I don't always agree with the amount that we're putting in. And particularly when we're operating in a deficit, I don't understand why we continue to do it. And it seems as though we will continue because now it's not coming out of fund balance. You're just going to take it off the top before you put it in premiums for employees. And you know, and I understand why you're doing it, but I just wanted to make it clear to the committee that this was from fund balance, and it's been taken out, and now we're down to 3 million. Not only because of OPEB, I realize we've operated in deficit years, but I just wanted to make that point clear. But thank you for your work, Pat.
Thank you, Katie. Any more questions for Mr. Dugan?
I have.
Carol?
Okay, I have the amount that the health plan put into OPEB, but Matt, can you give me the board amount that they put in, that total amount?
I didn't hear you, Carol. The what amount?
The total amount the board put in for OPEB. I didn't get that amount.
She wants the general fund amount.
Yeah, the general fund, because I couldn't keep up with everything you were saying.
To the insurance fund in the first slide, Matt, on the left.
Yeah, so the board funds about 80% of the premium. It's kind of an 80-20 spread. So it's about 13 million.
That's not what she's talking about. She's talking about what came out of general fund. The semantics that you are using to say it comes out 80% of premium. That's not what she's talking about.
I'm not talking about that. How much
before it ever got to him?
Give me a dollar amount, Matt.
Okay.
On the left side.
Dollar amount. I want a total dollar amount that came from the general fund.
On the left side, Matt, add up the general fund dollars and then add up the insurance fund dollars. And Carol wants to know the general fund dollars as opposed to the insurance fund dollars. Is that correct, Carol?
That's correct.
I have a question as Matt's gathering numbers.
Sure.
Miss Landry, Katie Landry, I wanted to understand, okay, so just so y'all have my perspective, when I was at the board meeting for the bond rating celebration, you know, they were telling us we had this double, was it A++? I'm sorry, I don't know the term exactly. Great
Double A plus. Double A plus.
Thank you, Billy. I asked them, they mentioned OPEB, and so I asked them specifically, you know, why is this important? Why is this such an issue? You know, but they made it I still don't quite understand everything about it, but they made it really clear that because we are ahead of all these other districts, like these other districts are not doing this, and they're going to fall behind in the future. They're not going to be able to cover what our OPEB will eventually cover. And one of the main reasons that we got such a great bond rating and we're saving so much money overall on interest is because we are being prudent and putting the money into OPEB. So Katie, what I wanted to ask you is, I want to understand your point of view. You're saying that this money should not go into OPEB, but it should go into what you're calling a rainy day fund. And I just want to understand that train of thought. Like, why do you feel that it should go somewhere else and not go into OPEB? I just want to understand both sides of this theory.
I understand, Ms. Mason. First of all, let me just say that money was earmarked for a rainy day, and then it was decided they would start, because we had what they considered an excess, they started moving it into a trust fund. But I can also tell you that somebody on the committee did some research a couple of years ago and checked bond ratings of districts that were contributing to OPEB, which were not many, and those that were not, and some of the ratings were identical with those that were and were not. So other factors go into bond ratings besides OPEB. That's just a very minute part. But there are other districts that were rated just as high as we were that were not contributing at that time. I guess my point is we're down to $3 million surplus. We could have had an additional million, so we could have 12. And, you know, in years when we have excess, big excesses, I can understand contributing to OPEC, but lately we've been dropping, and to continue to do that, now we're being told it's going to come out of premiums. So, you know, we're not going to even see it on top. That's pretty amazing.
So your main concern is that the premiums will go up because we've contributed so much to OPEB? Is that the bottom line?
Not necessarily premiums go up, but our benefits may go down. I mean, if we have less funding because it's going to OPEB, then, you know, in our claims, we could indeed end up with a larger and a larger deficit if part of that is going. I mean, I really think it should be a year-by-year decision as to whether or not insurance monies, whether it be premium or whether it be fund balance, be put into OPEB based upon our financial situation, and that hasn't always been the case.
Nancy, I was trying to speak, but I was muted. This is Burnell.
Sorry,
I can remember when we first started discussing this, I was under the impression that we did not have a choice. This was something that we had to be part of. And a few years later, we started surveying some of the various parishes and found out that at the time when we were surveying, I think it was maybe 2 or 3 parishes, us included, that were doing this. And when you asked the others, they were not real alarmed by not contributing. And I think that the problem today is that it's more of, I mean, it's fine, and I agree that we need to take care of the future and so on, but not at the detriment of the current people who are, because I mean, you're putting it on the back of people who certainly will never benefit from this. I mean, there's no way. And so you're currently using some of those funds that are harming the current balance, and it's creating the problem. So that, I think that's one of the things. So when you say the word, that's the reaction you get, you know?
And you know, Burnell, this is Butch. I totally agree with you, and you have to understand something. You know, Matt just told us that to bring it current, we're talking about $400 million. You know, if we put $1 million a year, it's going to take us 400 years. I mean, we cannot attain full compliance. We just can't. We don't have that kind of money.
No.
No. So, and I'm in agreement with you. I think maybe we need to look at and go forward and say, you know, maybe not $1 million a year, but maybe at least, you know, $400,000 a year, something that within reason. And if I can inject this, I've been on the air for a long time, and if I remember correctly, when we started talking about the balance as far as for the rainy day fund, I think we had asked that we kept at least between 4 and 5 million in reserve for the rainy days. So we're not that far from it right now, as far as that's concerned. But had we not been putting that much money in, yeah, our fund balance would actually be much, much higher. So, you know, but that's pretty much it. But when I look at a $400 million current liability, okay, yeah, like the fella says, it ain't gonna happen.
Anyone else with questions or comments about OPEB?
One other comment, Nancy, just for the benefit of the committee and the new members, is that, you know, DeSoto paid their full debt, but that came from shale oil when they hit it so well in North Louisiana. So they contributed a lot of their surplus from their shale oil to that, and that's how they were able to do it. And then Jefferson Parish is using their Deepwater Horizon settlement funds. So, I mean, it's not that and there are only 6 districts doing this, but they're not all doing it from insurance excess. Thank you.
And I think, Hannah, some of the confusion may have been the rainy day fund Katie referred to was rainy day insurance fund.
Right.
So those funds, the 2010, 2011, total of about $7 million that say insurance fund next to them on Matt's slide. If I'm understanding Katie correctly, those were rainy day funds for insurance that were removed from insurance reserve funds and put into OPEB funds.
Yes.
Yes.
May I say this too? We were never asked if we wanted to do this. We were told we had to do it. And I believe if you're going to take money out of the insurance fund, you need to allow the employees and retirees to have a voice in this money being moved. That's just my opinion.
Thank you. Anybody else?
No, that is not correct. That those monies were put, and it's when we created the trust, it's in the board item that said that this was being accumulated for OPEB. This was not a rainy day fund. It was being accumulated for the purpose of putting it to OPEB, and we made the transfer in 2 different transfers in the same fiscal year, one in 9/16 and one in 2/1.
This is Katie. I tend to disagree with you,
I
Matt.
do too.
At that time. So was Mr. Lemoyne.
Yeah, I don't agree.
Board item.
A question about the current situation. The committee voted to reduce the amount that went into OPEB, and it increased by $600,000. Can you explain that to me, Matt?
The committee, the board took it out of the insurance fund, but they sent the $1 million directly from the general fund.
So is the general fund reducing the amount of they're contributing to premiums equal to the $400,000 that would have come from I read a footnote in the budget, and it seemed to say, which I couldn't believe, but it seemed to say what the board was going to do was reduce the amount they would pay in premium by the $400,000 they would generally get from the insurance fund without telling the insurance committee.
The board item was revenue neutral in that it removed the $400,000 from the budget in the insurance fund, but it also removed the revenue to be net revenue neutral and to be run through the premium directly from the general fund into the trust on a monthly basis. Okay. That was the direction I was given to come to a revenue neutral solution that included the ability to charge the grants their portion of the fund. And then on top of that, the board sent another $1 million at the end of the year on 9/18.
So that's my question. So are you telling me that what's going to happen going forward, that instead of taking $400,000 from the insurance fund, the general fund will reduce by $400,000 the amount they would have contributed to our premiums?
No.
Is that what you're telling me, Matt?
Yes, in the spreadsheet for reducing the amount sent directly from the general fund through the premium structure, there was an offsetting amount of $400,000, but it was also reduced from the insurance fund budget as an expenditure to be revenue neutral to both funds.
So basically, it's going to decrease the amount of revenue by $400,000 that would have gone into the insurance fund.
And decrease the expense that was in the budget.
Right, I understand that. My other question is the $1 million extra that was put in 9/18. When that was done, was anyone aware of the status of our fund balance? I certainly wasn't, and I didn't know $1 million had gone in. But
that was from the general fund. It wasn't from the insurance fund.
I understand that, but when that $1 million was put into the general fund, was anyone in finance aware of the status of the fund balance of our insurance fund?
I can't answer that question. We probably should. 6/19. Those numbers probably weren't finalized yet.
It was a month ago today, just about a month ago.
Right. So I mean, the insurance fund financials. I was working on the general fund financials when the board made the transfer to the OPEB trust.
And my last comment is that there is no requirement from any general accounting standard at all about how much you contribute to OPEB, correct? There's no requirement that it be $400,000 a year, $500,000, $1 million a year. There is no stated amount of money that has to go into OPEB on an annual basis, is there?
No.
Okay.
Well, it's no wonder that if the goal is 400 million, it's no wonder that the other parishes have not even budged and said, I mean, because you're almost right at almost 60 parishes that have not contributed, you know. So it's no wonder if it's that much, no wonder they said, oh, forget about this, we can't do it.
Is there no other comments, Carol?
Nancy, I have a question. I'm trying to understand this. So is my understanding correct? If the board is going to not put 400,000 in the insurance fund, then every year we're going to have this deficit in our fund. So then I'm looking at this teacher who retired might be making $600 some dollars a month. So now we're going to put this on her back. I don't think the board understands what they're doing. I absolutely. I know that for a fact. People would not do that to people who have given their life to Lafayette Parish School System. And then now they have to take the burden of this? This makes
Carol, it was removed from the expenses. So there's no difference. There's no net difference to the insurance fund. It was removed from the revenue, but it was also removed from the expenses.
But Matt, right now we're looking at a fund balance of 3.6. So you're saying that, but I've heard things, and Butch said he's been on this committee. I think I've been a little bit longer than Butch. And I think I'm hearing things that in the past, and check the minutes, because we had somebody that took the minutes back then. And I know for a fact, I remember, we were always supposed to have this amount in our insurance fund before anything would go out anywhere. That's a fact. I want somebody to check that in the minutes for me. I know I'm getting old, but I remember that.
The effect on the insurance fund is zero because the revenue was removed, but so was the expense.
Madam Chairman, may I say something?
Yes, Justin.
I'd just like to point out that I think what Matt's trying to say, I'll try to say it a different way.
Thank you.
The transfer on last month was completely different than the transfers before that say insurance fund. Ms. Carroll, I think you're absolutely correct of transfers in the past were coming out of the insurance fund, which is why you see the $80,000 from employees. The transfer last month was completely out of the general fund. And so the difference, what Matt's trying to say is, in the past, the board would deposit money into the insurance fund from the general fund, and then it would go to the OPEB trust. The difference this time is we did not even deposit that money into the insurance fund. So no transfer out of the insurance fund went to the OPEB trust this year. Only the money from the general fund went to the OPEB trust this year. So
thank you, Justin.
So it's different in that this year, for it appears to be the first time in quite some time, no employee premium money is going to the OPEB trust, which I think addressed your concern, Ms. Carroll.
Yeah, thank you. I understand that now.
Justin, does that mean that in future years, the board will be contributing $400,000 less in premium money to the insurance?
I think it probably means that, but the point I was trying to make was when we would contribute $400,000 in previous years, that $400,000 would subsequently be transferred out of the insurance fund and into the OPEB trust. So it was never, that $400,000 was never going to insurance fund balance or anything. It was merely an accounting entry into the ledger.
I understand the accounting entry. My only concern is that now on an annual basis, there will be 400,000 or 500,000, whatever the board decides, in a decrease in payment to insurance.
Correct.
That's
but any future increases will come from the general fund. It won't come from the insurance fund.
But there's also, to Matt's point, there's also a decrease in expenditures in the insurance fund as well.
I understand.
Okay.
Mrs. Antani, it was really like a holding tank for accounting purposes. General fund would send the money to the insurance fund, Fund 85. It would sit there and hold for a paper trail. And then when it was time to pay, it would come back out of insurance. It wasn't designed to go into the reserve. It was just designed as a paper trail and holding tank.
That wasn't always the case.
Oh, no, I'm not saying, I'm just like the past couple of years.
That's right. It was not
Oh,
always. It
this
was,
year with the million.
this year is different than prior years, which I think
Exactly.
always
This
what I took
year-
away from these meetings was
But the rest, it was coming. So in
Right.
other words,
the concerns you had in prior years. I think the change this year was meant to address those concerns.
Okay.
Any other questions or comments?
My question would be,
I have one. I'm still waiting for Matt to give me that amount that the board put into OPEB at this point.
Matt, do you have those two numbers for Carol?
Dollar amount? I just would like to have that, Matt.
Yeah, if you add up mathematically, all the categories that say general fund only, it's 5,465,000. But remember the 3 million that was transferred in the beginning, that original 3 million that shows insurance fund was kind of a holding tank situation back in the beginning. So it's the same situation for 400,000, but the 300,000 initially was sent to the insurance fund and then transferred to the OPEB trust. So if you add that in, it's 8,465.
And Matt, how much is came from the insurance fund? That 3 million's in question because Katie's recollection is different than your recollection. So let's just leave that out. So if you leave that out of the 5 million from general fund, how much from insurance fund? And this is why it was on the agenda, because it's a significant amount of money and it relates directly to our fund balance.
6.478 with the 3 million.
6.478. Okay, any more questions for Matt? If not, we move on to Mr. Mouton. He and Carol are the longest, I think, serving members of the committee. And so Butch is going to give us a very brief, I hope, history of the committee and how it's worked.
okay,
Mr.
well,
Mouton?
basically, I've been on the committee as an active member as well as I led the group after Mrs. Guidry retired. And then until I retired, and then of course, we've moved on. So I've seen a lot of the stuff going on. One of the things I can tell you is that basically as an active member, we always looked at the retirees and we always did whatever we did, it was for them. And in the meetings, whatever they did, and when I say we and they, I was talking active versus retiree. The retirees worried about the active. So we always worked as a unit, okay? And from my recollection, some years active had a little bit more expense than retirees, and some years retirees had more expense than the active people. But in the long run, whatever we did as a group. So whenever there was an increase in premiums because of the increase in costs, and of course, as we've heard from Lynn, there's been an increase in cost. We've been so lucky because of a lot of the stuff, the savings that we've had have come from the generic medicines. And basically, we haven't had the increase since 17, okay? And I think that's a phenomenal thing. I think that's very much attributed to RX benefits in that they've gone and gotten a lot of the retirees on generics. I do understand that some cannot tolerate generics. They need the formulas that are put forward by the premium brands. But all in all, whatever we do going forward, I think we need to keep that sort of unity, that cohesiveness between the active and the retirees. And as I said before, when all this was set up and whatnot, if my recollection is correct, we had asked for a balance, or we called it the rainy day fund at the time. And with that, we had said between 4 and 5 million. At the time, now this is years, it was considered enough by the former third-party administrator that was enough to handle what we have or what we would have had. I think Lynn has done a great job in letting us not have any increases over those years. But as you can well see, you know, at 10 and 12% a year growth as far as for expenses in medical and pharmaceutical stuff, we have done a fantastic job. Now we're coming to a precipice. We're getting to a point where it looks like there's a cliff ahead of us, and we need to get over that. Okay, we need to find a bridge. So, are there any questions?
Thank you, Butch. I think that's the briefest I've ever heard you. I appreciate it very much. If there are no questions or comments for Mr. Mouton, and we want to thank him and Carol for their lengthy service, because having people who have been on the committee as long as they have, along with having people like Katie and Burnell that have a historical perspective, I think helps all of us. It certainly helps me understand better. Now we go into old business. For those of you who missed our last meeting, the committee requested that the board give the committee time to gather additional information on the AGWIP program. That program is a program that would put retirees on Medicare Part D, as I understand it. The board and the committee had approved it with the understanding that there would be no changes for retirees. There was some confusion about whether or not that was in fact going to happen, if it would just happen for 1 year, and then it would be different in succeeding years. So the request, thankfully, was granted by the board, and thank you to Hannah and Justin for voting to give us the time. And thank you to Trish and Brooke, who works for Lynn and Hub International, for sending us reams of paper to read, answering the questions and concerns, or at least addressing them if it didn't answer them. First, as per our request, we're going to hear about first the AGWIP plan, and then from either Trish or Mr. Fontaine, I don't know which one of you would like to present that, and then hear about the 3% premium increase, and then we will entertain any motion on one or both of those. So the first item is AGWIP. Is that Trish or Lynn Fontaine who'd like to present that or the information?
I'll take that.
Okay, Mr. Fontaine.
All right. Trish, you okay with that?
I'm good. Let me know if you need me to pull up any documents while you're speaking.
You have
right, so I'm going to go off of what was submitted and kind of in that order. And these were basically the order of the questions taken from the prior meeting. So the first item would be on formulary, and we submitted a summary of the formulary with the material from Brooke and Trish. I will tell you that the formulary from previous meetings and what was presented is about a 99% match with regard to your current formulary. And then, of course, what's been presented is the additional coverage or wrap to take care of that gap. So with this program and the way it's designed, there should not be any discrepancy in the formulary because of that 1% whose drug might not be in the formulary. That's where the additional coverage and the wrap will take place. So,
and that's just for existing medications, correct, Lynn?
Correct.
So I don't want to give people the impression, because that was one of the calls I had, if they were to get a new prescription from a physician in January or February, that would not be covered by the wrap. So they would see a change, because the wrap is only covering existing drugs, correct?
That's correct. So going forward, I'll give you additional explanation on that. Going forward, you're going to have a formulary, okay, that is almost identical to the one you have, okay? Also, there are several medications in every one of these categories. So we're not offering a situation where Doctors have less choice of medications to, because there's actually new medications added to that formulary. And just in your current situation where you are right now with RX benefits, that formulary is updated on a quarterly basis. So formularies are always going to have some change to them. So those changes include sometimes a drug will go from a tier 1 to a tier 2, tier 2 to a tier 3, or vice versa. Sometimes you see drugs going from a tier 2 to a tier 1, tier 3 to a tier 2, that type of thing. In the analysis, there were probably more drugs that went up in tier than went down in tier.
Could you explain what that means in terms of increased cost? What an increase in tier means?
An increase in tier means you go from one copay to another. So for example, when we talk about a tier 1 copay being, for example, a $10 copay on a generic and a preferred brand being at $25, $35. So let's see, Brooke just put that in front of us. From a benefit standpoint, but just paying the different copay for the higher class. You see your copays for your basic plan, 15 is tier 1, 45 tier 2, 70 tier 3, and then of course especially at 10% with a maximum of 150.
So everyone understands the higher the tier, the higher the cost, correct?
Right.
Mm-hmm.
And as I mentioned, there are probably more drugs in the Silver Script formulary that are having a tier reduction than that are having a tier increase. But tier changes are going to happen quarterly in your current situation. They're going to happen semi-annually in Silver Scripts. 99% match on that. And then, of course, having the wrap to take care of anybody who could find themselves in a situation where their drug is excluded from the formulary. Next were the authorizations, which are addressed in the opt-out letter information.
Yes.
So what we did in the opt-out letter is we made certain, one of the things that was of concern was wanted to make sure there was no confusion in the opt-out letter, wanted to make certain that nobody opted out accidentally. So we took initiative to change that opt-out letter to make certain that if somebody wants to opt out, that is sent to back through Lafayette Parish School System, because we don't want anybody to opt out accidentally.
Great.
Okay, and as far
Thank you for doing that.
One more time, please.
I said, thank you for doing that.
Okay, well, that was a request, and it made all of the sense in the world, because, you know, with some folks, let's say you've got somebody who's way up in age and maybe misinterpreted and sent the opt-out letter incorrect. We don't want anybody having that situation and losing coverage where that wasn't their intention, because the only way anybody would lose coverage is any open enrollment. If you have somebody who's retired and says, I don't want the Humana Medicare Advantage, I don't want to belong to the Blue Cross plans, I don't want RX benefits, I'm going on my spouse's coverage. They can't make that decision and change their mind and come back next year. That's always been the case, and nothing is changing on that whatsoever. So a couple of things that I'll answer on this is...
Lynn, just a minute. Mr. Santani has a question.
I was just asking Ms. LaBeouf to move her mouse so I could read it. I did have a question about the language, though, Mr. Fontaine. Is there any way, now I don't want to, micromanage this at all, but I would really like to see something along the lines of, okay, there it is. I see it now. You do not have to do anything if you want to be enrolled in the plan. Like, I really wanted to see some language, something like, don't do anything. Unless.
We're going to remind them constantly throughout these communications that, don't do anything, do not opt out, unless you want to leave the plans entirely. And if you do opt out, send it through the Lafayette Parish School System so we can make sure that's what what your intention was.
Lynn, can I interject something, please?
Yes, sir.
Okay. Basically, you said if you went to Humana, you couldn't come back on the plan. Historically, that's incorrect.
No, that's not what I'm saying, Butch. I'm saying you can go to Humana, okay, and come back all day long. But if you don't want anything that the Lafayette Parish School System has to offer, and you waive both of those plans, you're not coming back. So, for example, if I was your retiree and I said, nope, I'm not taking any of the coverage, I'm getting away from the school system's coverage, and I'm going on my wife's plan, she's works for ABC Incorporated, I can't do that for a year and come back. That's always been your rule, because retirees can always stay on your plan as long as they've had continued coverage. So if somebody chooses to go on Humana, next year they want to come back, that's fine. They have that choice every year at open enrollment, Butch.
Yes. And that was always, but when you mentioned that, you said when they get off, they couldn't come back, and you had mentioned with Humana. And I think that's just simply inadvertently, you just said Humana. And that's what caught my ear.
I got you.
Lynn, is there going to be language that, or are you all going to do this by phone if someone opts out? You will explain to them if they opt out, they will never have coverage from the Lafayette Parish School System, including health coverage?
Yes, ma'am.
When we that by phone, Trish?
Yes, ma'am, we will. We'll make sure that we have all the correct verbiage, because there's technically 3 numbers listed there. My number's the first one. We've got Pam Belmore, that's the 53 number. And we've got Tamara Reeves on that 65 number. So everyone's gonna have the same verbiage. That way we can make sure that crystal clear that they don't need to opt out, and we'll talk them through it.
And you'll have the facts as well about, there is no change to your plan. This is, very similar to what RX benefit, all that stuff.
Yes, sir.
My concern about that, Justin, is similar to the concern we had last year when inadvertently in July, we went up and in some areas, deductibles or co-pays, and it was the same time that people got a raise and they connected those two. My concern is if we tell people there's no change, and they get a new prescription, because this is just covering prescriptions, they go to the doctor in January and they get a new prescription and it's a tier 3 drug. The WRAP is not going to cover them. So they are going to think that is a change. This medicine is going to cost them more than it would have cost them because there could be a tier change, a formulary change, etc. And that's my concern. If we say nothing's going to change, and in January they get a new prescription not covered by WRAP that may not be on the formulary, then they're going to have to go through an appeal process. And so things are going to change for them. But it's changing because there's a different drug, not because of the plan. Do you understand my point?
I do understand your point, yes.
I need to ask this question. Speaking of change, it might not be the right place to it, but to Lynn, today I sent in my check for my Medicare, and it was for 3 months right at $800. And I was looking, and I'm on Part A and Part B. And you mentioned just now about Medicare Part D. So that means that would be, I'm going in that direction. Is the next step, and I think this is critical for me, the next step is that the retirees will be put on Medicare Advantage. Out of curiosity, I called several of the doctors that I deal with, and several of them don't handle Medicare. They will not take Medicare Advantage, which puts it really it's very, very serious for me. So when we're speaking of changes, the next step is not to get into Medicare Advantage. Am I right?
You are correct. I'm glad you asked that question. This has nothing to do with a Medicare Advantage plan. You have a Medicare Advantage option in your Humana plan, which is a group Medicare Advantage plan, which is totally different from an individual Medicare Advantage plan. but this does not change any of your Blue Cross coverages at all. It's basically no different than when we moved from Blue Cross handling our prescription drugs to RX benefits. But the difference is it's a much, much closer match formulary-wise, and it also has the wrap. So to close that gap.
But Lynn, there is a difference, because if you don't go on, when we switched over from Blue Cross to CVS, okay, we didn't lose coverage. If you didn't go with it, then you didn't lose coverage, as far as I know, with the health insurance, did you? There was no opt-out situation, as far as I remember.
That's correct.
You just simply moved this.
Right. And this is the same type of situation. You can opt out because the CMS has to give you that option. That's just part of their ruling there. But if you opt out of that, basically, that is the coverage that's proposed to go alongside with the enhanced or basic plan from Blue Cross.
And that's the difference, Butch, I think, that we need to be careful of. This puts us on Medicare Part D, which means it's basically run by CMS, and CMS is the Center for Medicare, Medicaid. So it's run basically through RX Benefits, CVS Caremark, Silver Scripts, whatever you want to call it, but they are accountable to the federal regulations of CMS.
Gotcha.
Okay.
So Miss Nancy and Mr. Lynn, a couple of things. One, I just wanted to say, when you were talking about if you have a new prescription in January that you've never had, right? And you're going to get it filled, and the formulary might be different from where we were on the CVS mark. Since you've never had that prescription filled, you don't know whether your copay or your tiers would have been different. So, because it's a new prescription. So it might be different. And we've seen our prescription, I've experienced where my copays change, even being on the same plan for a while. So I think that's to be expected. The other thing I wanted to say is it was really important. I talked to Ms. Fontaine after the meeting and to Ms. LaBeouf, and it was really important for district staff, including the superintendent, to make sure that the direct line to central office was put on this letter and not a 1-800 number, because we did not want anyone retiree not speaking to someone directly in our office. We thought it was vital that they had a connection so someone could take the time to and explain that. So that was definitely not just a request from your committee or from Ms. LaBeouf, but I actually got off the board floor while the meeting was still going and had a discussion with Mr. Fontaine before the meeting was over, because that was really important to all of us at district level and the superintendent. So I just wanted to say that thank you for following up with that, Mr. Fontaine and Ms. LaBeouf, and getting that in there.
Okay, so can we say this then? Can we say that no one will be dropped until they have been contacted by the school board? Can we say that 100%?
It depends on if CMS will let you say that.
I say no one's going to be dropped unless they call us, right?
Yeah, that's right. You have to call.
That's correct, because everybody is automatically enrolled in the program.
You automatically.
So you're not signing up. So when we were talking about the letters of people signing up for it or signing out of it, everyone is automatically enrolled into the program. In order to get dropped out of the program, you have to have a phone conversation with our insurance department.
Okay.
So with that method, Butch, you are correct in your assumption there, because you would have to contact the school system to opt out.
Right.
Lynn, this is Trish. Hey, Brooke, am I correct in stating that on our last conference call, they said we would get a spreadsheet of those members if for some reason someone decided to opt out? Am I correct in stating that? That way we could still follow up with them prior to it going through.
we're going to direct these members to the Lafayette Parish School District, but with the magnitude of the documents that are going to go to everyone, if someone by chance calls the 1-800 number in lieu of the school system, they're going to provide a spreadsheet to us letting us know that your members called, and then Trish will know who they are and reach out to them directly.
That's what I was concerned about.
That's another fail-safe, Butch, to make certain that we contact everyone.
Super.
Katie had a question.
And I have a question as well.
Okay, Katie first.
I just have a comment. I do want to thank staff and everybody involved in this for reconsidering the opt-out to protect our retirees from accidentally doing that. I know that took a lot of effort, and I do appreciate it. That was one of the requests we had at our last meeting. So thank you.
You are so welcome, Ms. Landry. That was very important to all of us, that we wanted to make sure that that didn't happen.
Carol?
I have a question about the tier. Lynn, is there a max out of pocket? Because I'm looking at tier 4, percent of retail. Is there a max out of pocket cost that members will have, or is this 50%?
There's a max out of pocket. The maximum copay for tier 4 is $150, and then pull up the maximum out of pocket for prescription drugs.
It's $1,250. So once a member's copays reach $1,250 in a calendar year, your coverage is at 100%, and that's exactly as it is now, and that's not changing.
Okay.
No benefits are changing whatsoever.
Okay, Lynn, you want to continue?
Not changing.
Lynn, you want to continue?
Okay. So we talked about the example letters here. 3 letters that would go to any members, and of course, once again, about 1% of the membership is that if anybody has a change in tier, if the drug coverage instructions as far as to any kind of PA or anything like that. And then, of course, if their drug is no longer covered under the plan, they get a letter and they'll have the opportunity to have that drug approved if their physician wants them to take that versus anything else on the formulary. One other thing I'll mention with regard to the formulary going forward, and Jennifer kind of touched on this. Remember that when a physician's prescribing a medication, they're going to be looking at the medications in your formulary. So that, they'll have plenty to choose from in every diagnostic category out there, because this is probably the most or one of the most lenient formularies that the SilverScript program offers. Next was with regard to our pharmacy networks. And we submitted back some time ago the Excel document that was previously provided to show you not only what's local, but statewide. And on top of that, there'll be information sent to all of the members, which will identify all of the drugstores in a 20-mile radius from their home address.
Lynn?
Yes?
Before you go on, one of the documents that we were sent, and they aren't labeled except it says SilverScript and the Lafayette Parish School Board on it, it says important SilverScript information. On page 3 says the formulary and/or pharmacy network may change at any time. We were of the impression that the formulary and the pharmacy were not changing, except I think we were told twice a year the formulary would change, or maybe it was quarterly, I don't remember. But this says the formulary and/or pharmacy network may change at any time, which is correct.
Dr. Campbell, you want to address that?
Yeah, so CVS will not make any negative changes to the formulary other than biannually, but they may make changes to the formulary where they add new drugs that come to market at any given time throughout the year, but no negative changes other than 2 times a year. So as it pertains to the network, the same would be true today for the active as it would be for the retirees. So generally speaking, the network ebbs and flows, pharmacies come and go, but there wouldn't be any anticipation that there would be any negative changes to the network for the retirees that would not affect the actives as well. So I guess suffice to say that I think there would be no negative changes that would affect the retirees.
In either pharmacy or formulary? Thank you very much.
That is correct.
A question, Nancy. Well, order will still have access to the mail order component?
Yeah.
Mail order for prescription?
That is correct.
Yes.
Yes, you will still have access to the specialty pharmacy as well as the mail order pharmacy.
Lynn?
All right. Next item was with regard to the contract. We had questions around the terms of the contract, and we sent that information in, and then we also sent a follow-up with that, giving you confirmation that there is a 90-day cancellation clause in this contract. I think it's 13.2, but I also submitted in writing confirmation from Silver Scripts that the 90-day opt-out applies immediately.
So Lynn, does that mean that you're changing, or Silver Scripts will agree to a change in the terms? I know that what you're referring to is in the section C under termination rights, but the conflict is with 3.1, which is the terms. We talked last meeting about a 1-year contract. This is a 3-year contract.
It's a 3-year contract with the ability to terminate at any time from day one on with a 90-day notice.
So will that change be added to 3.1 since 3.1 is not worded that way? 3.3C is worded that way, but 3.1 is not worded that way.
Correct. So I gave you the confirmation
Correct.
from Silver Scripts that 13 point, that actually the C takes precedence.
Correct. But will they change the terms as well? Will they change
the 1-year contract?
No, I don't know, whatever everyone agrees to, but my concern is making sure the wording for the 90 days that I got in that separate letter is also in the contract itself, not just in C, but is in 13.1 in the terms.
We can get them to clarify in that language, but the interpretation of that language from them, and it's their contract, is this is a confirmation that the 90-day term language indicates that Lafayette Parish School System can exit prior to the 3-year contract being fulfilled. So if we want something from their legal department clarifying and confirming that, I'll get that to you, definitely.
Well, this is Katie. That's my concern. And I saw the letter. However, that's from a person who may or may not be there in a year. But the contract itself, when you read the terms, says it may be terminated at any point for breach of contract, and that the 90-day opt clause is applied after 3 years of contract being effective to renew. I would feel, because we all know that a contract is a legal document, I would much prefer if the language of the contract is changed to guarantee that we have an opt-out right at any point for good reason. But the way it's worked,
we'll see to it that reads correctly, because that is their that's their contract. Their contract will allow us to get out from day one with 90 days. So we'll make certain that that's properly documented.
Yes, please make sure that's in the contract, because that is the legal document if we go to court, they're not going to care what anybody says. It's going to be what's in the document that we sign.
Understood.
Thank you.
All righty. We've touched on the opt-out information, customer care. There was inquiry as to where customer care it will still be direct to the 1-800 number, and that'll all be given out in the emails. Virtual training and education materials. We've edited the PowerPoints to clarify who to contact if opting out, same type of conversation that we had with regard to the opt-out letter. A lot of reminders in there not to opt out, all of that. And then there will be virtual training that will give dates to the retirees and send out communications on that as well. We also submitted, when I say we also submitted a FAQ to kind of give clarification to a couple of different things here. If we can get that pulled up. These 5 questions were real material to you folks, so we wanted to get this in writing to you. And some of this we've already covered. But as a Medicare eligible retiree currently participating in Lafayette's basic or enhanced, does the EGWIP plan change my medical benefit or prohibit me from seeing any current medical provider? The answer to that is absolutely no. It does not affect your medical benefits, your providers, your PPO network, none of that. Secondly, will participating retirees have to change pharmacies? We've covered that. It's the same pharmacy network as your current CVS Caremark network. So no change there. As a Medicare eligible retiree participating in the Humana Group Medicare Advantage plan, how does Silver Scripts affect my coverage? Doesn't affect it at all. You won't even be participating in it. If a Medicare eligible retiree chooses to opt out of the basic or enhanced plan, we've covered that. And Butch, once again, if they go to the Humana Group Medicare Advantage plan, they can return in subsequent years. That's what open enrollment's all about.
Okay, that doesn't change anything. That we've done that for years.
Absolutely. Number 5 is a Medicare eligible retiree currently participating in basic or enhanced. Will I have to change my medication? We certainly have covered that. We're covering 99% of those meds. The additional coverage, the gap, will close that gap and give everybody no change in their medications. And then final one, SilverScript Medicare Part D prescription drug plan reference different stages in Part D. I put this one in here, and Brooke and I did so we could clarify any confusion that anybody might have as to, you know, if we're going into a Medicare Part D program and we're not changing benefits, we're not changing the drugstores or the medications or anything like that. Everybody, most of you are familiar that a Medicare Part D plan has different stages. None of that affects your benefits whatsoever. You pay the same copay as you paid before, and same maximum out of pocket, all of that type of thing is there's no change in that copay structure. So going through these 4 different stages really is irrelevant to the plan member. It's what produces the savings to the plan through EGWIP. Basically, EGWIP is just going to allow us to get more reimbursement from the government.
Yep. So we thought it was very important to put that on the FAQ, just because when you guys are getting these documents in the mail, you're going to see reference to these different stages. and they don't apply to you. So throughout the documents, we try to add language right below it that says, hey, you're with Lafayette Parish School System, and remember you have co-pays and an out-of-pocket maximum that's going to cover all of this. So we try to add that language right underneath all of that throughout the documents.
But the reason you have to send this as it is because CMS requires you to?
Correct.
There were, we also talked to the cash flow of it, which we submitted earlier. And I can basically tell you on that, we've given the cash flow of how the plan will operate and submitted that as well. And basically, when we take into account what we're currently spending and the estimated spend on the EGWIP plan, you can see at the bottom, all of the red is the monies that we get in throughout the year. And that's going to total $6,736,597 is the estimate. So if we're talking, if you look at the numbers at the bottom, our estimated 2021 current plan cost for the retiree population, including what we get back from our RDS plan subsidies, is $8,340,000. The additional savings with the EGWIP program brings that number down to $5,554,595. We have to also subtract from the savings the additional EGWIP administration fees of $202,608, giving us a net savings of the $2,583,493. Mr. Guidry had asked for the monthly estimates of how this money would flow. One other thing I might want to share with you on this is that you know that our rebates are paid in arrears, 6 months in arrears, okay? So during the calendar year of 2021, we're not going to receive the third and fourth. Well, we could receive that third quarterly rebate in December. Sometimes by the time they finish the audit on them, we're receiving it in January. But at the same time, you have that the reinsurance GDCA is going to be all the way to December of 2022, because that's when that audit date is completed. So there's some of these monies that actually flow in after the calendar year would be completed.
Lynn, the $8,340,000 figure was what?
$8,340,000. If we take the census of your retiree eligible Medicare population, and what they did is they took their gross prescription drugs and subtracted from that the co-pays, all of the co-pays that they paid, the member share from that, and put in the discounts and rebates and all of the other things. It takes that 8 million, it comes out to $8,346,096. But what's also included in that, Miss Nancy, is that subsidy payment that we get every month from RDS.
So your total projected savings for this plan that would affect just retirees on Medicare, as I understand it, your projected savings for our fund balance, which is in not good shape, would be what number, Lynn?
$2,583,493.
A little slower. 2,500,000.
It's on the bottom of the page that's on the screen.
Now I see it. 2,583,493. Okay, thank you very much. Who would I ask a CMS question to? Dr. Crawford?
We've got Dr. Campbell or Cheryl Howard's with Silver Scripts. It depends on what the question is.
I was asked this question CMS has a 5-step appeal process. If somebody needs a drug and it's not on the formulary and they have to appeal it, will our retirees have to go through the CMS 5-step appeal process?
This is Dr. Campbell. So yes, today the appeal process includes 2 steps. The CMS actually is a little broader in that it allows an appeal from a provider as well as appeals from the member. So there can be as many as 5 appeals between the provider and the member for an exception to the criteria.
And does that increase?
So it is much more broad.
And it would it increase the time someone would have to wait for the resolution of the appeal, in other words, to get their medication?
No, there are timelines associated with expedited appeals and standard appeals, but those timelines are the same under the current process as they would be under the CMS process.
Okay, and my last question on this issue is for Billy Guidry, if he's still around. 100% of the savings, the $2 million that Lynn just spoke of, 100% of that is going into the insurance fund. Is that correct?
I don't believe Billy's on the call anymore, but I believe that would be correct. Oh, he's on the phone. Okay.
I'm still here. Any rebates would be recorded in the insurance fund. I would want to, I do just want to mention that if you look at the cash flow schedule by month, as I had mentioned before, the insurance plan runs by calendar year. We report for it on a fiscal year. So the impact of the egg whip in fiscal year 21, the current year that we're in, is going to be a little over $1 million. I want to say it's about 1.2 million. I just want to bring that to y'all's attention. The rest of it would be recorded in fiscal year 22. So that's just an FYI, but all of it would be reported in the insurance fund.
Thank you very much.
Yes, Miss Nancy, and that was the whole purpose of Mr. Fontaine, who's done a great job of getting this egg whip, help us get set up, is so it can stay in the insurance fund to build up that reserve and watch our premiums.
So Lynn, from all the different things that you talked about, what we're going to be getting, do you feel like the plan will be on fairly sound footing?
Absolutely.
All right.
You know, when we talk about different things that we could bring to the plan to stabilize the cost, stabilize the budget, I don't know of a strategy that can bring you $2.5 or $2.6 million with reducing any kind of change. I mean, the other changes we've looked at are benefit reductions, or premium increases, and obviously this is less or far less of any kind of disruption to a plan member.
So this is Dr. Campbell. If I could make a comment, I do want to point out that let's just say you had somebody in January who had an unfortunate illness and cost you $1 million in plan costs next year. Because of this program, the government will absorb 80% of that cost, and under your current structure, you would absorb 100% of that cost. So there is a remarkable protection effect for those catastrophic expenses that could occur going forward.
And that was a catastrophic document that was sent to us, I think, by Trish. Thank you very much, Dr. Campbell. Any other questions or comments before we move on to the next item, which is a 3% premium increase, which I guess is Mr. Fontaine as well.
I provided documents on that, if we can get that pulled up. And this is on your basic plan we have your current employee or retiree share, the system share, and then the total. And those are our funding rates right now. So when we talk about what we're funding versus what the plan cost is, basically when you see funding on that report that I provide to you, on those first couple of pages, and we tell whether we're in a surplus or a deficit, the funding is a result of the number of people in each one of these categories multiplied by these figures. So for example, if we have 1,000 people in employee or retiree only, it would be multiplied by the 154, then by the 528. And when you see on my report, employee share, board share, that's where that shows up. So a 3% increase would take the employee or retiree's contribution from single coverage from 154 to 158.62, all the way to a family where you see employee or retiree 2+ or more at 625, okay? That employee or retiree share going to 643.75.
Okay, if I can interject. Okay, I did the calculations on the 3%, and basically on the first one with employee or retiree only, you're going to have a monthly increase of only $4.62. Whereas if we go to the top one, which is the employee or retiree with 2 or more, you're going to go up $18.75 for the 3% increase. So everything else is in between. It's, $10, $15 or whatever.
Correct. And one other thing that we all need to keep in mind is that premiums are pre-taxed. So the real net effect of this increase, so if you take a family, and as Mr. Butch said, is $18, okay, remember the net effect of that payroll decrease is going to be less than that in an amount equal to whatever their tax bracket is. So if we said an average tax bracket of, let's say, 20%, you would be taking 20% off of that $18 figure, or about $3.60. So roughly you're talking about $14.50 to $15, depending on that tax bracket of how that would affect that family premium.
Well, I have a question. It's Katie. Your table of increase, does that take into account less the money that the board will provide for our premiums? Or is that just based on what the premiums are now?
So this is basically what your premiums are right now, and applying a 3% increase to the employee retiree share as well as the board share.
Okay, so since the board has decided to take $400,000 off the top before going into premiums, it may be just a tiny bit more than that, right? The premiums? Because you won't have the same amount of premiums, monies coming from the board.
That really is irrelevant of that, if I'm understanding you correctly, because if the board were to adopt this premium structure, that's what they would be funding into the plan. And I believe and guys, if you're still online, I think that would be a separate transaction, correct? The $400,000.
Mr. Guidry, I think it's, so the $400,000, so the amount that the board contributing to the employee share remains the same as it always has. Correct, Mr. Guidry? So whatever we've committed to as the board share for the system share will stay the same. So if it increases, it stays the same. The $400,000 that general fund was already putting in insurance is different from, and then as a holding tank and coming back out, that just is staying in general fund instead of doing a transfer, but the amount that the board will still be contributing to the system share would stay the same. Correct, Mr. Guidry?
But Jennifer,
can you hear me?
Yes.
Matt, you can chime in, but it would be my understanding that that portion of the premium that relates to the OPEB contribution would increase as well. The board may have the option of leaving it where it's at, the current amount, and picking up that increased portion in the board share. But I would understand it as initially that the 400,000 would increase by 3% as well. But that can be discussed. That's not set in stone.
I have a question. This is Shannon.
Thank you, Shannon.
And forgive me if we've been over this already, but when would these premium increases take effect?
If they were approved, I would assume January 1, Lynn.
Is that, yeah.
So yeah, and so we do have a, and I know it's kind of ahead, but maybe it's better now to talk about this option. If the premium would go into effect, we have met, I've met with Ms. Trish. I spoke to Ms. Trosclair. I'm gonna let Trish talk before we go any further so you can understand that since the open enrollment is already in place and some folks have already changed their plan from maybe a basic to an advanced or an advanced to a basic, we felt it was very, very important if this does change and goes to the board on November 11th, that we gave employees a little bit extended window to change their plan either again or say, okay, it went up, maybe I need to relook at it. So Trish, do you want to take 2 seconds to explain kind of what we came up with as a benefit to employees and retirees to have this option? If we did increase, we didn't want to just have it cut off and say, oh, well.
That's correct. Ms. Gardner, go ahead. Typically, our open enrollment for health insurance ends on Friday, the 13th of November. But we've looked at the calendar. We think it would be best to extend that to right before Thanksgiving. That would give them about an additional week and a half on top of what we already have, because we're on the 21st of October right now. So we'd extend it to right before Thanksgiving break. That would allow them to just review everything, make sure that they don't need to make any more changes if they've already submitted something. And we can certainly delete the changes that we already have in place if the member wants to make changes based on the increases. But we will certainly work with the employee, give them a little bit of extra time and work through anything that they've already submitted for corrections.
And so we thought that was important because last year when we made a change in benefits, not premiums, in July, we got some feedback, because the copays went up or the amount of deductible for your prescriptions went up a little bit. So we thought this was the perfect opportunity to make sure everybody had the opportunity to either change it, readjust. We wanted to add another window.
Great. I think
the staff is considering an increase in I'm sorry, but is the staff planning on increasing the premiums?
Well, I think that's what Mr. Fontaine was delivering options to us as also doing the EGWIP, but also considering, it's the board's, it's the advisory committee's recommendation to the board. I think that's why the discussion's going on.
I strongly feel that this recommendation needs to come from the staff and not this committee, because all these ramifications that you're talking about, that all has to be considered by the staff. So therefore, the recommendation to increase premium should come from the staff and not this committee.
Well, I think the committee, I think it was requested to see what it would look like, and that's what Mr. Fontaine is looking.
That I have no problem with. And I agree with what Lynn talked about. I appreciate the board for allowing us to hear it again, because a lot of misconceptions were clarified, and I really appreciate that. But for increases at this point, I think that should come from the staff, because y'all gonna have to look over a lot of these different things and what needs to be done, and not coming from the committee, I don't believe. That's my personal opinion.
Mr. Lemoyne, this is Justin. I'll say that this is coming from the staff in conjunction with Mr. Fontaine. I have always appreciated the fact that this committee was willing to look at this and review it. I think what the board kind of relies on this committee to do is look at these numbers in conjunction with how the plan is performing overall. And just, if a change needs to be made, just tell us whether we're doing it fairly. Because, you know, I think we all understand that increased healthcare costs is a way of life. But we want to make sure that we are doing it in an even-handed manner. And that's one of the unique perspectives that this committee can give the board as we manage the plan.
So Justin, you were saying that the staff is recommending this 3%.
I don't know if they're recommending the 3%, but they're the ones that are saying, correct me if I'm wrong, Jennifer and Lynn, you guys are saying if the plan needs additional financial help, this is an appropriate way to do it, correct? Or are you saying the plan needs additional financial help and this is what we should do?
So if we take a look at all of the data that we talked about recently, and when Mr. Billy was talking about fund balance, and we know that fiscal year last year, we ended with about a $3 million deficit. We got $3.8 million in our fund balance now. Our plans is very much repeating a 2019 plan year type of performance with about a 2.9% increase, which has increased lately from, although normalizing from some of these higher cost claims coming in, that, you know, not only do we need those savings from EGWIP, which Mr. Billy also said that would be about $1 million coming into the plan over the course of the remainder of this fiscal year. But in addition to that, needing some additional funding to not go into any type of further deficit or further deplete that fund balance. So that's the reason why we're showing both the 3% and the 5%. When considering,
excuse me, the 5% is not on the agenda. We cannot.
No, please. And can I say this, Nancy? I want to represent all the retirees that are paid. I mean, you know, when you have a teacher working 37 years and she's making $600 some, I want you to be cognizant that everything in her life is going up. Cost is going up. She's not getting a cost of living raise. So when you say the 5%, that's a big hit for that person. So I just wanted to say that.
Appreciate it, Carol. And one thing we left out of the AGWIP that needs to be mentioned is that I think it's a deduction, the possibility of a deduction in Social Security if based on your income, that your Social Security amount, those retirees, because we have retirees who are on Medicare, retirees aren't on Medicare, retirees on Humana Advantage. They're a diverse group as opposed to the actives who are all actives. But I believe that depending on what your income is, your Social Security check can be reduced a certain amount. Is that correct, Doctor?
Brooke, you want to cover that? Because we talked about that this afternoon.
Certainly, yes. Part D, so when you enroll in a Medicare Part D plan, there's going to be a feed that occurs between SilverScripts and CMS. So CMS is going to be notified that you're now enrolled in Medicare Part D. There's no premium for Medicare Part D. However, certain situations and certain members, if you fall in a high income category, and I'm not really sure how many years CMS looks back and looks at your income, but it could trigger what's called Medicare Part D IRMA, and it's an investment related I'm not going to say tax, it's an adjustment per se, and you don't know about it until it starts coming out of your Social Security check. So there's no way for us to know what retirees are going to fall into this category. But if you know you have it and you see the deduction coming out of your Social Security check, Trish's team is aware that this could possibly happen, and the intent is never to charge a retiree more to participate in this plan. So if you fall into this category, contact Trish's team, and they'll make sure that a retiree would be reimbursed for that. The majority of the population is not going to fall into that category. But
will that information be shared with all the retirees, that they can be reimbursed?
That's not going to be in the silver script material. However, reference to Part D IRMA, you will see that throughout the CMS material.
Well, I think it's important, because that's why I'm concerned about saying there's no change. That's part of how we got here, because these little things that might not apply to the majority, but it may apply to some. Just like the change in the formulary may apply to some. So we need to be careful when we say there's not going to be any change, because there could be for some people. Thank you, Brooke.
Yeah.
Any more questions or comments from anyone about either AGWIP or a 3% increase in premiums across? Now that would be across the board, Lynn, for all of our plans? Not just basic, correct?
Basic, enhanced, and the high deductible Blue Saver.
So they would all be included.
Correct.
Do you have a total of what that amount would generate for our, or does Billy, for our fund balance?
I have that in front of me, Lynn.
Okay, Brooke?
You want me to share that? It was the bullet points we gave.
I don't see the bullet in front of us right now.
Okay, I don't have it. I'm going to bring it to you. Hang on. I don't think Trish has it shared on the screen.
Can somebody just give us the number real quick?
Yeah.
Yeah, 3%, I believe, is 1.4 million. That's annually.
That's all we needed. Thank you very much, Billy.
And that's for 12 months. Just keep that in mind. And it's not going to necessarily increase the fund balance by that amount. It's going to be available as revenue to offset claims. So, okay, very good. Thanks.
So what we have is AGWIP, which is just for retirees, which would add a savings of $2,583,493, and a 3% premium increase that would, you saw the numbers that would add to each plan, or we just saw basic. Now we have the high deductible plan that would generate 1.4 million. So we can either entertain a motion now for one or both and then have public comment, or if Trish has any phone calls, we can take those phone calls now. Trish, since it might change what the motion is.
No, ma'am, I don't have any current phone calls. You wanna reiterate the telephone number? We can.
The telephone number is
521.
Thank you very much.
7018.
Thank you.
We do have a call. Hold on one second, y'all. LPSS, this is the public comment line. How can I help you?
I'd like to make a comment for the employee insurance committee.
You have 3 minutes to respond. Yes, ma'am. Can y'all hear it? Let me ask that question.
Yeah, I can hear.
Okay.
Yes.
Yes, ma'am. Please go ahead.
Hey, this is Debbie Hargrave. I'm a retired teacher, and I taught with the Lafayette Parish School Board for 40 years.
Thank you, Miss Debbie. We can hear you.
Okay, and I just want to thank the committee, especially the active employees and Nancy and Katie, since they really don't have a dog in this fight. But, okay, great. So, and I want to really thank you for all this work and all this study. But I just want to understand that I think Nancy is totally correct. We should not tell retirees there will be no changes. I just don't think that can be totally accurate. And to kind of understand where I'm coming from, the old idiom, you know, that if something looks too good to be true, it probably is. And I'm not sure how y'all are going to save $2.5 million. But I nonetheless greatly appreciate the work, and I appreciate the 2 school board members that have tuned in for these committee meetings.
Thank you, Miss Debbie.
I think we have to wait again, and the phone number is 521-7018.
So you just have to wait about 20 more seconds.
And if someone could be thinking, we will need a motion relative to AGWIP. If everyone wants to continue with AGWIP, there really is no motion that needs to be made because this committee already approved it. If you want to change that, the proper motion would be a motion to rescind.
Ms. Mounts, this is Vicki So. I have a question.
Sure, Vicki.
There was a motion made by the board last Wednesday to rescind.
Correct.
Where is that now?
Okay, what the board did, our committee, if you may recall at our last meeting, had a number of questions, which is why we had this, and we're having all of these responses. Because we needed more information. We went to the board and said, would you give us some time to gather more information, particularly about the contract and about the opt-out provision. The board voted, my recollection is 6-2 because someone was absent. The board voted to rescind their prior approval in order to give us time to have this meeting and make a decision about what we were going to do with AGWIP once we got all the information we needed. Currently, as of our March meeting, AGWIP was approved. So if people no longer want AGWIP, the proper motion is to rescind. If people are satisfied with AGWIP, we don't need a motion. We do need a motion, however, for the 3% premium increase. So the 20 seconds has passed, so I will entertain a motion on either AGWIP and or the 3% increase.
Nancy?
Yes.
Didn't a motion pass at the last committee meeting with recommendation of the board to rescind? Would that still stand if we don't make any kind of motion?
The board has called a special meeting for October the 28th based on what this committee does. The board is going to meet at a special meeting on October the 28th is the latest correspondence I had from Mr. Latchley. One of the board
so wouldn't the board need some kind of recommendation from us, not based on our last recommendation to rescind?
I think what we could do is just say that, a motion that from the information that was provided, that we move forward with the recommendation with Silver Script, whatever you want to call the whole thing.
Now, are you making that motion?
Yeah, go ahead.
I think it's clearer, Nancy, to the board because our last motion was to rescind it. And if we don't say anything in this motion, to me, the board is looking for I know there's 2 board members on the call right now, but the board would be looking for some kind of direction from this meeting, no?
Yes, I would say we are definitely looking for direction.
I
definitely think that from the information that was provided, I think it's a win-win situation from right now.
I have no problem with an additional motion. Everyone needs to understand, however, that this committee never rescinded its action. It made a recommendation that the board rescind its action. Ms. Landry tried to make the motion to rescind what this committee had done, and Mr. Santani was helpful and suggested that we make the motion to the board to rescind. So the motion that exists on the floor in the minutes of this committee meeting is that we approved AGWIP. If it is clearer that based on, as Brunel said, based on this information, we support the AGWIP program, then we need a second to Brunel's motion.
I second it.
That's Matt Dugas, CG. Is there any more public comment, Trish? 521-7018.
Not currently. No, ma'am.
We have Jennifer's high-tech timer device here, so we have a.
I just want to say, I want to echo what Ms. Hargrave said. I don't think there's an employee insurance committee, Butch can correct me if I'm wrong, or Carol, that has worked as diligently and has spent as much time as all the actives and retirees have on this committee. And I know I appreciate it very much. I text y'all and remind you of meetings and call you and harass you to make sure you show up. And I know I am personally extremely grateful, and I would assume that the Lafayette Parish School Board is grateful for all the hours you volunteer to this committee. All right, all those in favor of continuing with the EGWIP program, say aye.
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 Anyone opposed? All right, we will send that recommendation to the board. And now, is there a motion to implement a 3% across the board premium increase to generate $1.4 million to pay for claims?
Miss Nancy, if there's someone's going to make a motion, I believe, should we state that it's beginning in January? Shouldn't there be a specific timeline of when that would start?
Good idea. Is anyone going to make that motion?
Can I remind everyone, I'm not allowed to make motions. So if
you know that well.
Y'all cannot unanimously approve it. So y'all gotta keep me in check, okay?
Yeah, we have to go back and correct that, Hannah. We will in December.
Okay, this is Butch. I'll make the motion that we increase by 3%, okay? From what Lynn has said, we're looking at the 19 situation again. So therefore, it looks like we're gonna have another deficit according to past history. So my recommendation would be a 3% increase, which is basically covering on the basic plan anywhere from $18 down to $4.62.
Down to $4.
Yeah.
So and as of January 1, 2021.
I just feel very uncomfortable about that the raise is coming from the committee. I feel very uncomfortable with that.
Can we add, Butch, can you add to the motion as recommended by staff?
As recommended by staff.
That's okay with me.
I'll second it. This is Donna.
Butch, don't forget we have a large, the second 800 and some odd people on the Blue Saver plan, and that increase is 30 cents.
There you go. So we have to understand, and I do believe all our people, and I'm talking about active, I'm talking about retirees, they understand that medical costs are going through the roof. And we have Lynn, he's telling us that, the projection is we're going to lose again, and that's simply because of the high claims. So it's going to have to happen, and we just as soon take it in little bites instead of having a 5% next year.
Yeah. Everything does increase. I mean, even as, everyone ages, you're going to have it the doctor restricts your visits. It's going to, like the gentleman just said, it's going to have to start somewhere. And it's better being at 3 than 5 or 10.
And I think also it's going to help that and we're talking here, the insurance committee comprised of, active people, both in the office, in the schools, and the retirees, that we do it together as we have always done it.
I have a question, Nancy.
Yes, Carol.
My question is this. We're banking on EGWIP providing $2.4 million. If we don't reach this projection, are we going to be coming back for an increase in premium?
I can't speak for Mr. Guidry, but I would think if this committee passes the 2.5, which I understand is they aren't going to get all that in January. And if we have a big set of claims in January, that's where this 3% is going to come in, because it's going to provide us $1.4 billion. So I can't speak for the board, but I can't believe after what we've been through this year that they would come back to us next year and ask for another premium increase. But as I said, I don't know what could happen, Carol, but I do think, and I would ask Mr. Fontaine, that we not get into this situation again. And I think if we have our fund balance on our agenda so we all see it every time we meet, that if we need a 1% or 2% increase 2 years from now, that we don't allow ourselves to get back into this situation. If you go back to the list Mr. Guidry showed you initially, where our fund balance was up to $8 million and now we're down to 3.6, and he's not comfortable with it being below 3.6, which I think is correct and a very, very conservative estimate. So I would hope not, Carol, but I can't predict the future.
Miss Nancy, I know we cut Lynn off earlier because we were talking about the extension, that if we move to this 3% increase, and I know Mr. Butch made the first motion, but can I just ask real quick, Mr. Fontaine, I know you didn't finish going through all the levels, but I know we've talked about this when I started with insurance back in March about the possibility of this increase due to the significant changes we put EdWIP in, but this is still the recommendation, I'm guessing, from you being as our third-party administrator of really watching it because of our fund balance and everything, correct?
Correct. You know, the high cost claims that came in post the stay-at-home order, excuse me, were obviously more than anybody expected. You know, during a year when you have a pandemic, which we haven't faced in the past, it's very hard to get a clear picture of what expenses are going to be. And just like Miss Nancy said, all of this is predicated on claims experience. A group your size gets to be pretty predictable after a while, but it can change and spike either up or down. Hopefully, we have some calming of these claims, but in the last couple of years, if you remember from this reporting, the number of these high cost claimants, and then when you add a couple that are approaching $1 million claimants, that's what makes for the big change. And that was a rarity in this year.
And I do agree that the insurance committee, since I joined all this committee stuff since about the last January, I know that through discussions of these meetings, the insurance premium increase has been always put on the back burner. It's not what we wanted to do. And so we took different avenues back, I think in March, and put into effect in July with a few changes we could, hoping to avoid this because it's not where we wanted to go. But this is where we are. And Mr. Fontaine, I know that the committee has, I know Ms. Landry, I remember Ms. Landry bragging about what great things you have done for us to try and prevent where we are right now. And we've done an excellent job in moving forward, putting some other things in place. But I just wanted to make it clear that, you know, the board, the Insurance Advisory Committee has done a really awesome job trying to prevent what we're having to do tonight to sustain our fund and build up our balance.
Thank you. This is Katie. I have one request. When this is presented, can we just remind everyone that we haven't had an increase in premium increase in 3 years, and the committee thought it was necessary in lieu of rising cost.
Ms. Landry, I think that's excellent. I think that's not only an excellent point of not pointing out how long it's been since we've had an increase, but also what the committee has met and what we've done to try and prevent it. Not that we just haven't had it, but what you have done as a committee to try and prevent by doing other things. And it's not only affecting the most of the actives, the increase in some retirees, but also the retirees' prescription. I think if you look at it as a whole to see what the committee has done to try and prevent this, it's a good thing.
If you look at it mathematically, it's 1% a year. Really, and Lynn, what has inflation been in the healthcare industry over the last 3 years?
6 to 7. You're playing with your benefit structure more towards 7
per year, or
the medical inflation. Healthcare inflation's been about 6% on the medical side, about 12 on the prescription drug.
Yeah, I was told 12 today.
And that's per year. Is that the cumulative the last 3 years?
Per
I'm
year.
being attacked by a mosquito.
Per year.
Oh, is it per year?
Mm-hmm.
And we've had a 3% in 3 years. So I think I really think the amount of time and effort everyone, the staff, Lynn's staff, we can't leave Brooke out, Trish, her staff, Billy, his staff, Jennifer, everyone who has worked on this, but specifically the committee members. I know how tough it is to work at school all day and then come spend 3 hours doing this, but it's necessary for the actives and retirees to work together, and I'm very proud that you all are still of that mindset. So,
You know, I want, this is Donna. I'd like you to know when Miss Landry asked me to join this committee, we'd meet 4 times, and I've met my limit already. Done.
Look, Donna, this is.
Well, Donna, we'll increase your pay.
Oh, you can't afford me and I already work for you.
all right, the motion on the floor, ladies and gentlemen, is a motion with a recommendation from the staff and the consultant to increase premiums by 3% beginning January 1, 2021. Is that cover it, Butch?
Yeah, yes, ma'am, it does. The committee agrees to that. Also, I would like to interject, and I don't know if this has to be put into the motion, but when we send out the new amount, could we just put, like, for example, basic, if you're going to be in this particular category, it's only going to be $4.62. Instead of giving them the 150 plus, or the 180, some of them have a tough time with math, and especially with the new math we have. So if we could add, just your increase will be such and such on the basic, such and such on the enhanced, and such. I think it's going to make everybody just a little bit more comfortable. Oh, well, I'm only going to be, charged $5 more a month. That's a lot.
So, Ms. Gilmore, maybe a column that actually shows, instead of going from 700 to 724, maybe you say 700 is going to go up $24 a month. That's just a guess I used. But maybe showing the amount it goes up, not just the new total and the old total.
That is what that's exactly what I'm saying. I think it'll be a lot more palatable.
Okay, not a problem.
As Lynn pointed out, that is pre-tax. What they're going to see in their check is going to be even less, by probably about 20%.
So we can tell them that as well, which would be good.
We can put a couple of sentences to identify that as well.
Perfect, thank you.
Any more questions or comments?
I'm gonna restart the timer. I'm on 11 seconds. I'm gonna go ahead and continue it to get to the minute for public comments. Miss Nancy, would you read the number after you get your second motion?
No, the second motion's already been made.
Okay, can you go ahead and reread the number?
5217018. I read it when we made the motion, so we should have already well past the time. We can do it again.
For the motion, that for the agenda item in the public content part, if we can make sure that we outline the monthly increase, and then also note that we haven't had an increase in this number in however many years. Just so if anyone doesn't watch the meeting, I know I have a lot of constituents that just read the agendas, and I get lots of comments from that. So I just want to be very clear on the agenda item.
Thank you, Hannah. CG, did I miss something from you? I don't know if you're still there. I must not have. I can't see your time. Okay, thank you.
I'm still here, but you didn't miss anything from me.
Okay, thank you. Is our timer done, Jennifer?
Yes, ma'am, you're done.
All those in favor of the 3% increase with the rest of that motion, which I think is beginning January 2021, and not as part of the motion, but with all the other requests that Ms. Landry, I think, made, and Mr. Lemoyne made. All those in favor say aye.
Aye.
Aye. Opposed? Is there a motion to adjourn this meeting?
This is Donna. There you go.
Donna and Clyde.
Ms. Hollis, you can take anybody's name.
The motion's adjourned, and again, thank you very much for a great job, folks.
Have a good night.
I'll put
Thank you.
Good night, everybody.
Thank you. Good night.
Lynn, thank you for being there. It was great.
Thank you. My pleasure.